Imagine setting up your investments one time and never stressing about them again. No constant rebalancing, no second guessing, no endless research. It sounds great, right? Well, that's exactly what all-in-one ETFs offer. In this video, I'll show you how they work, who they're best for, how to choose the right one for you, and how to invest step by step. And at the end, I'll cover some very common mistakes that I see our clients make so that you can avoid them. So what exactly are all-in-one ETFs? Well, they're also known as asset allocation ETFs, and they're meant to simplify investing by bundling multiple ETFs into one. It provides instant diversification across stocks, bonds, and global markets without the hassle of picking individual investments. What do they invest in? Well, let's take Vanguard VGRO as an example. With over $6 billion in assets under management, VGRO is one of the most trusted all-in-one ETFs in Canada. It provides exposure to a broad range of global stocks and bonds, giving investors an instantly diversified portfolio. With stocks, it has an 80% asset allocation. With a mix of Canadian, US, international, and emerging market stocks, it offers access to over 13,000 companies worldwide. With bonds, it has a 20% allocation, and it's a blend of Canadian and global bonds, helping to stabilize a portfolio during market downturns. Diversification. Instead of relying on a single market or sector, VGRO spreads investments across different countries, industries, and asset classes to reduce risk and enhance returns, all at a low fee of 0.24% MER. If you take a look at the top 10 holdings of VGRO, it includes some of the biggest names in both the US and Canadian markets like Apple, Microsoft, Nvidia, RBC, and Shopify. You can think of an all-in-one ETF as kind of like a financial smoothie. Instead of picking and measuring each ingredient like your stocks and bonds, you get a perfectly blended mix that's ready to fuel your financial health. So how has VGRO performed? If you had invested $10,000 into VGRO from the 5-year time period of January 2020 to 2025, your investment would be worth about $16,000 today. That's the power of a globally diversified, low-cost portfolio working for you over time. And that's over only a period of 5 years. You could imagine what your returns will be after, say, 20 or 30 or even 40 years. The benefits of an all-in-one ETF and why investors love them. It's a low-cost alternative to mutual funds. One of the biggest advantages of all-in-one ETFs is their low fee structure, especially compared to traditional mutual funds in Canada, which typically charge about a 2% MER, which really eats into your returns. You can see here on RBC's site that many of the mutual funds they have charge around 2%. All-in-one ETFs, on the other hand, usually charge between 0.2 to 0.25% MER, which is much lower and much more cost-effective. Then they also auto-rebalance, which keeps your portfolio on track. There's no need to manually adjust your asset mix. The ETF automatically buys and sells within itself to maintain the right stock-to-bond ratio. It's also perfect for smaller accounts. If you're just starting out with a TFSA, RRSP, or other investment account, one ETF gives you instant diversification without needing to spread money across multiple funds or stocks. Then there's my favorite feature, which is the diversification and time-saving aspect of it. Instead of researching and buying dozens of stocks and bonds, you get a professionally managed portfolio with exposure to thousands of investments worldwide. Some people have called all-in-one ETFs a boring way to invest, but that's exactly the point. As economist Paul Samuelson put it, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. So who should use all-in-one ETFs? Here are some common scenarios where all-in-one ETFs make the most sense. You have your beginners who want a simple, low-maintenance portfolio. If you're new to investing and don't want to worry about picking stocks or rebalancing your portfolio, an all-in-one ETF does everything for you. Just invest and let it grow. Then you have your busy professionals who don't have time to manage investments. If you have a demanding career or business and don't want to spend hours researching investments, an all-in-one ETF keeps your money working in the background without requiring constant adjustments. For me, this is where I land. I love researching and picking stocks, but sometimes I just don't have enough time to do all this due to my very busy work and life schedule. Parents investing for their kids' future. If you're investing in an RESP or another long-term savings account for your child's education, an all-in-one ETF provides instant diversification and requires very little maintenance. Then you have your small account investors. If you're starting with a smaller account, like a TFSA or RSP, and want diversification from day one, a single all-in-one ETF is perfect. It gives you exposure to thousands of stocks and bonds without needing multiple purchases. Speaking of TFSAs, if you're serious about growing it, check out my free guide on the 5 steps to building a $1 million TFSA. You can download it now on my website. The link is in the description. Which all-in-one ETF should you invest in? With so many options available, it's easy to get overwhelmed when choosing an all-in-one ETF. But here's the good news. The company itself isn't as important as picking the right asset allocation for your risk tolerance and investment goals. The Canadian ETF landscape. Canada has several major providers offering very high quality all-in-one ETFs. My top picks are from iShares, which is owned by BlackRock. It's known for XGRO, XBAL, XEQT, and more. Then you have Vanguard, which offers VGRO, VBAL, VEQT, among others. Then you have BMO, which has ZGRO, ZBAL, and ZEQT with strong diversification, and it has that big bank brand that a lot of people like. There's also Horizons, which has unique swap-based ETFs meant for tax efficiency for your non-registered accounts. These providers all offer low-cost, diversified, and auto-rebalancing ETFs that simplify investing. So how to choose the right one for you? Instead of focusing on the ETF brand and company provider, ask yourself, how much risk am I comfortable with? And I'll go over this in more detail in the next section, how you can exactly figure this out. If you want something with higher risk and high returns, you'll look at something with 100% stocks and 0% bonds. So that's like your VEQT and XEQTs. If you want a more balanced approach, but still have some growth, there's VGRO, as I mentioned before, and XGRO, which has 80% stocks and 20% bonds. But if someone has a lower risk but steady growth approach, you'll look at 60% stocks and 40% bonds, so VBAL and XBAL. If you're more conservative and looking for more stability, you'll have something like 40% stocks and 60% bonds, so that's more like your VCNS or XCNS. It's more your risk tolerance and investment goals which should drive your decision. Not so much the ETF provider, as long as they don't offer something with a very high fee, which all of these providers offer around in the same ballpark. Pick the one that matches your comfort level and let it do the work for you. How to invest in all-in-one ETFs, step by step. Here's exactly how to do it. First step is to determine your risk tolerance. Before buying anything, you need to figure out how much risk you're comfortable with. This helps you choose between a more aggressive ETF like VEQT or a balanced one like VBAL. A quick way to assess your risk tolerance is by using free tools like the Vanguard Investor Questionnaire. It asks questions about your comfort with market swings, investment time horizons, and financial goals, helping you find the right mix of stocks and bonds. Then step number 2 is to choose a brokerage. Next, you'll need a brokerage account to buy your ETF. Some of the best options in Canada include Simple Trade, which has 0 commission fees and is great for beginners. And Questrade is great as well, which also offers recently 0 commission fees. Then you have big bank platforms like TD Direct Investing or RBC Direct Investing, and it's good for those who prefer big bank platforms, or maybe you already bank with these providers, so it provides convenience, but you will have to pay more. Make sure to open the right type of account, so you have your TFSA, RSP, or non-registered, based on your investing goals. Step number 3 is to buy the ETF. Once your account is set up, it's time to buy your first all-in-one ETF. And this is how most brokerages work. So I'm just going to give you kind of a broad overview. First, you log into your brokerage account. Then you search for the ETF. For example, type in the ticker of VGRO or ZBAL. Then enter the number of shares you want to buy. Choose a market order, which lets you buy immediately, or a limit order if you want to set the price you're willing to pay. Then confirm the purchase. And that's it. You should get a notification that it's been purchased and you're now officially invested in this all-in-one ETF. And here's an optional step. It's to set up a DRIP, which is an automatic reinvestment of dividends. This means any dividends paid by your ETF will automatically be used to buy more shares instead of just sitting in cash. Most brokerages let you enable DRIP in the settings, or you can call customer support to set it up. This helps you compound your growth over time without any extra effort. And if you really want to get lazy with investing, automatically contribute some of your paycheck every month into this all-in-one ETF. A common question I get is one fund enough? And the answer is yes, all-in-one ETFs are meant to be standalone investments per each account. You don't need to mix them with other ETFs. In fact, adding more funds can mess with the carefully designed balance. Each one is built to match a specific risk level, whether you're aggressive, balanced, or growth focused. If you start mixing and matching, you might throw off your asset allocation and accidentally take on more or less risk than you intended. But if you want to experiment beyond an all-in-one ETF, you can use separate accounts for different strategies. Here's an example of a potential setup you could consider. For your TFSA, you can keep it simple with a single all-in-one ETF, like VGRO for long-term, tax-free growth. Then for your RSP, you could build your own stock portfolio if you want to pick individual stocks while keeping a portion of your portfolio passively managed. And for your non-registered account, you could focus on, say, tax-efficient ETFs, like Horizon swap-based ETFs to minimize taxes on dividends. Common all-in-one ETF mistakes to avoid. Even though all-in-one ETFs are designed to make investing easy, people still make a lot of mistakes that can hurt their returns that I see. Here are the biggest ones to watch out for. The first is filling out the investor questionnaire wrong. If you don't answer honestly, you could end up in the wrong ETF. Too conservative, you might not get enough growth. Too aggressive, you could panic in a downturn and sell at the wrong time, which is what I see all the time. Take the questionnaire very seriously to match your actual comfort level. The next big mistake that I see is getting bored and tweaking too much. The biggest advantage of all-in-one ETFs is their set it and forget it approach. But a lot of investors can't help checking their accounts too often and making unnecessary changes. Constantly tweaking your investments or selling your all-in-one ETF because of market swings can really hurt your long-term returns. Patience really pays off. And the other biggest mistake that I see that I mentioned earlier was buying too many ETFs in the same account. Some investors buy multiple all-in-one ETFs or combine all-in-one ETFs with other ETFs thinking they need extra diversification. But all that does is mess up the built-in balance and makes things more complicated than necessary. For example, VGRO already has 13,000 companies, so that's more than enough diversification to match anyone's needs. Pick one that fits your risk tolerance and stick with it. So if you want to avoid these common mistakes and want personalized guidance and a plan tailored to your financial goals, check out our financial planning services at Blueprint Financial. We'll help you optimize your investments, save on taxes, and grow your wealth. And please hit like and subscribe for more Canadian investing tips.